Charlie Munger's stern warning to investors. Charlie Munger, the current vice chairman of Berkshire Hathaway, has been Warren Buffett's trusted business partner for many years. However, what many may not realize is that he is a wealthy investor in his own right with a net worth of $2.3 billion. Charlie Munger emphasizes the importance of investing at the right time, and he's fully aware that things will only get worse from here. With global financial markets affected by high inflation and rising interest rates in 2023, what is Charlie's investment advice for investors to make the most of the impending stock market crash and worldwide recession? Hi, you've reached Finance Sense, the place where we discuss all the most recent trends in the financial markets and the economy. Before we get started, make sure to give this video a thumbs up, hit the bell notification button, and subscribe to our channel so that you can stay up to date with our new videos. Having said that, let's get started. In the field of value investing, Charlie Munger is unquestionably one of the names that are held in the highest esteem. At the ripe old age of 99, he continues to serve as Berkshire Hathaway's vice chairman, having been Buffett's trusted right-hand man for decades. However, as many of you are probably aware, he is also a highly successful investor with a net worth of $2.3 billion, and a significant portion of his investment success has been attributable to his logical thinking. It's something that's benefited us much throughout the years he's been doing it. Currently, the market is expected to decline by 20%, inflation is still relatively high, and interest rates are projected to rise further in 2023. Therefore, the most evident investment hurdle we will face in 2023 is the fact that it appears we will be investing in a bear market this year. The S&P 500 plummeted 20% in 2022 when interest rates were raised to 4.5%. However, it seems that interest rates will continue to climb in 2023 as a result of the Fed reiterating its goal of bringing inflation back down to 2%. With our assets all down 20% since about 2022, the first question is whether or not we should invest at this time. Is it worthwhile given the possibility of future hardships? Charlie claims that the economy might occasionally experience boom times and down times. But you have to go through both, since we all have to keep swimming through both situations, whether the tide is in our favor or not. The economy might sometimes work for you or against you, but long-term investors don't mind if prices fall dramatically in the short term. Rather than attempting to time the market precisely, it's better to take advantage of these periods and view them as long-term opportunities, even if they make us feel horrible. When asked in an interview from 2008 how concerned he was about Berkshire Hathaway's stock price declines, Charlie responded with, "Zero. This is the third time Warren and I have watched our holdings in Berkshire decrease by 50% from top to bottom." He further added, "I think it's the nature of long-term shareholding with the normal vicissitudes and worldly outcomes. And in markets, the long-term holder has his quoted value of his stock go down by, say, 50%. In fact, Charlie argued that if a person is unwilling to respond calmly to a market price loss of 50% twice or 3 times in a century, they are unfit to be common shareholders and deserve the mediocre results they would ultimately receive. And the reason for this is that identifying good businesses and keeping them for a very long time is the foundation of proper value investing. That is actually how the majority of stock market riches are built. There is no waiting for the ideal moment and no speculating. There is simply the option of investing in high-quality businesses, sticking with them through both good and bad times, and then taking advantage of downturns as long-term purchasing opportunities. But to be able to accomplish that, one must possess an extraordinary level of emotional intelligence, and one must train oneself to the point where one actually does not care whether the stock market is rising or falling. The greatest way to accomplish this is to acquaint yourself well with your plan. Therefore, be aware of your goals and the steps necessary to reach them. Additionally, you must carefully assess the companies you have bought and your ability to commit to a long-term plan. Charlie demonstrated his peculiar indifference to market conditions when he stated, I'm consistently invested in American equities, yet my Berkshire stock has declined by 50% 3 times. I'm not too bothered about it. It doesn't really matter if you have my attitude. I've always liked the line from Kipling's poem, If, when he says, "Success and failure. Treat those two imposters exactly the same. You simply accept it. It may work in your favor and work against you at times. Everything is part of the same game." Munger's advice is merely to go with the flow. Make wise judgments for the long term and profit from market declines. And the next time someone tries to tell you to avoid the stock market, buy some fancy new cryptocurrency, or focus on the upcoming year since that's when you're going to make money, just go back to Charlie's response in an interview when he was asked, "Are old school Ben Graham valuation techniques dead?" And he replied, "That's what an investment is, getting more value than you pay for. You must receive more value than you pay in order to be successful." Now, you can find a whole group of people who don't even know what they're buying. They're just quotations on the ticker. Consider the wild booms in the past and how they turned out. The South Seas bubble, the late 20s bubble, and so on. This has existed ever since the birth of capitalism. There have been crazy bubbles. Essentially, you simply have to have faith in the process. Value investing will always exist. In situations like the one we're currently seeing, we plan for the long term, seek high-quality businesses, and purchase them. But before we go too detailed, let's look at the current scenario because increasing interest rates will likely force equities to decline once more in 2023. And on top of that, we have to deal with rising inflation. So, what is Charlie's advice for implementing value investing ideas in a case like this? What will happen in the end, and what additional tips does Charlie have for individual investors to better manage the effects of inflation aside from investing in high-quality stocks? He said, "You may have to pick the best option out of a bunch of bad ones. This is a common way for people to make decisions." The Mungers also own a number of apartment buildings, Costco shares, Chinese equities through Lilu, a small share of Daily Journal stock, and Berkshire stock. Does Charlie believe this to be perfect? No. Does he think it is okay? Yes. The most important lesson from the Mungers is that diversification is unnecessary. According to Charlie, if you have 4 good assets, consider yourself fortunate. If you're striving to perform better than average, you should consider yourself lucky if you have 4 things to buy. Asking for $20 is like requesting an egg in your drink. Only a small percentage of people are intelligent enough to make 20 wise investments. Moreover, as Charlie previously stated, the market might be full or against you at any time, and it's possible that you'll need to choose the action that won't hurt you the most. Any investor would find it challenging to be in that position while rates are soaring and inflation is surging. With rates at 4.5% and rising, it's unlikely that you'll see returns comparable to 2021 this year. However, as Charlie points out, the lesson from the Mungers is to simply invest in high-quality assets and stick with them. Is Charlie's portfolio flawless? No. Is it adequate? Yes. You don't always have to strive for annual returns of 20%. And keep in mind that the majority of value investing consists of, essentially, just observing and waiting. You choose the things you want to buy, wait to see when they go on sale, and then buy them once they do. You don't have to worry about the macroeconomic environment or what to buy the following week. Charlie and Warren believe that having 1 or 2 opportunities per year is enough. And most of the time, it's the people that make matters too complicated. They experience FOMO, otherwise known as the fear of missing out, and strive to take advantage of every offer. They are the ones who inevitably get themselves into trouble. So in situations like these, we need a sound plan, emotional control, and the acceptance that we cannot always have our way. With that said, what kinds of businesses should we be paying attention to in these trying times? Charlie responded by saying, "We want to buy something that is fundamentally a really strong business. That is, a complete moron could run it, and it would still work well. And then we want that business, which even a fool could run well, to be run by a great person. And if we have a great business with a wonderful person running it, which really turns us on and it works very well, We favor companies that put up with a lot of poor management but still succeed. If a company is strong enough, it can maintain its resilience. Warren says that when a business with a reputation for being hard and a manager with a chance to be great come together, the business's reputation stays. If they start out tough, they stay tough. Such advice from Charlie is arguably the most important thing to take away from investing in this type of setting or environment. You want strong businesses that can make it through hard times and still be fine. Now, what exactly does this mean? It signifies that the business has an inherent enduring advantage over its competitors, is not excessively reliant on debt, has not flooded itself with loans that may bring the company to its knees, its business model is effective, and the company makes healthy profits regardless of the economic climate. Finally, it also signifies that it is simple. As Charlie pointed out, if you're a genuinely long-term shareholder, an idiot would likely lead that firm at some point. So you want a company that an idiot could run, and it would still be okay. Overall, it will undoubtedly be difficult, but if you can keep your emotions under control, invest with a long-term outlook, wait patiently for chances, and keep it simple, you'll be in a strong position to succeed in 10 years. Thank you for watching this far. Please leave a like, subscribe to help us expand our future audience, and comment down your thoughts in the comment section. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. Stay safe and look out for the next video.